We're about to introduce a new element into our trading knowledge: investor sentiment. And the reason we'll do that is because there's no better way to explain the concept of support and resistance. Quite simply put, if we look at a historical chart, we'll see that prices tend to range between two main levels. They may be long-term or they may be short-term, but they're always there. If we look at oil, we'll see it's rarely broken through $120 or below $20. The top level represents the maximum price buyers are prepared to pay, and the bottom, the level below which production becomes a losing venture. To put it into practice, and if we limit ourselves to market players, support is the level at which buyers believe prices are at their lowest possible level. That's when they begin buying in order to later make a profit. The immediate result is that demand begins to increase, supply begins to diminish, and prices begin to rise. Now, resistance is the point at which they believe prices are at their maximum, and they start selling before prices drop. The result, of course, is that supply increases, demand decreases, and prices begin to drop. It's kind of a self-fulfilling prophecy. A ranging market is when the market establishes those two prices, support and resistance. It's found a bottom and a top for the time being. In a ranging market, the market will in essence bounce up off support and bounce down from resistance. To be able to call it a ranging market, it needs to trade within that range over a number of different time frames, whether that's a minute or a monthly chart. The gap between those prices can vary. It could be 5 ticks wide or thousands of dollars wide. It just has to stay between those two prices. In the short term, the most common reason for a ranging market is market indecision. The market neither wants to break beyond a certain price to the upside or the downside. When a ranging market reaches support, this may indicate an oversold asset. The prices below what the market feels is the real or fair value of the product being traded. Conversely, when a ranging market reaches resistance, the market considers the asset overbought or at a price level which is higher than the fair value of the asset. So, how do we determine fair value? Well, for a share, that's relatively simple. It's the real value of a company's asset and sales potential divided by the number of outstanding shares. For a commodity, the price of its production and sales chain. For a currency, it's a little more complicated. We assess the country's economy. We may use the Big Mac indicator. Any number of theories, really. There may also be periods when the market tends to go quiet, possibly as a result of there being no fundamental factors driving prices. If there's been no news of major changes in exports or production, no geopolitical or weather factors, the market is not likely to have reason to move beyond these two levels. Lacking fundamental indicators, market speculators may have less incentive to be involved in the market. The result is a lack of volume, momentum, and/or conviction to move markets. A surge of volume and market may move the market out of the range. So always be cautious and try to anticipate news that may have a lasting effect. When a market finally breaks a key level to the upside or the downside, it may move in the direction of the newly established trend, creating possible opportunities. If both support and resistance hold, the best thing to do is play the range. And that's when one buys near support and then shorts near resistance. And this can go on indefinitely. The main concept here, though, is that being long on a low or short near a high can be dangerous. Will we reverse or break through? Only the fundamentals can tell.